Welcome to Overberg Asset Management's market review for October.
Good morning, everyone. It's been a fantastic quarter. I really do need to think quite hard to remember a quarter that has been as good as the one we've just experienced, not just for local markets, but global markets as well. And of course, when the markets keep going and fresh record highs are reported, I'm sure you probably come across a lot of clients and even your own concerns that possibly it can't last forever, and sooner or later there's got to be some kind of a consolidation. Indeed, valuations do appear quite stretched in the US and even outside of the US, but valuations or expensive valuations are not enough in themselves to cause a drop in the markets. We need some kind of a catalyst prompt a fall in the markets. Of course, there are threats. Fiscal deficits around the world are mushrooming. We've got policy risks, particularly in the US, where government policy is quite unpredictable. And we have the risk of inflation. Certainly, the tariff impulse will cause inflation to pick up a little bit from current levels. And we've still got the residual effects from the pandemic. Inflation, apart from some pockets of the global economy, by and large, haven't returned to their sub 2% targets. All these risks would manifest themselves in higher treasury and sovereign bond yields. And that really is the biggest risk to the markets. Not so much recession. The biggest risk is that bond yields misbehave. They go up to new cyclical highs, and that will cause a de-rating in the markets. This is a note from Capital Economics, and I quote, "Much now depends on Scott Bessent, a key moderating figure that markets see as one of their own, remaining in his post as U.S. Treasury Secretary. If he were to fall out of favor with President Trump and replaced with someone with weaker market credentials, then this could be the trigger for a sell-off in the bond market. Likewise, if concerns about Fed independence continue to grow, then this could push up long-term bond yields and feed into fiscal concerns. The decision on who replaces Jerome Powell as Fed chair when his term expires in May next year will, needless to say, be critical." And of course, the peak of tariff concerns is past us. But just last week, President Trump announced that beginning the 1st of October today, the US will impose 100% tariffs on imports of pharmaceutical products, 25% tariffs on imports of heavy trucks, and then a couple of other ones less important economically, but just indicative of the fact that the tariff threat is not totally behind us. 50% tariffs on the imports of kitchen cabinets, and 30% tariffs on upholstered furniture. The reciprocal tariff threat may be no longer as risky as it was, but product-specific tariffs are still a threat. Now let's move on to bond yields. The 10-year Treasury bond has remained below its previous cyclical peaks, but there's definitely been a sell-off in 30-year Treasury bonds. And it's not just the US, but it's also the sovereign bonds in the UK, Germany, and France as well. Those yields have reached their highest levels in more than a decade. They've come back a little bit in the last 2 or 3 weeks, but it was a source of concern about a month ago. And there are various explanations: fiscal policy, overly accommodative monetary policy, and then, of course, the policy risks. And all those risks are having an effect on the term premium. The term premium is what investors require for investing in long-dated bonds as opposed to continuously rolling over shorter-dated bonds upon maturity. So that duration risk is unnerving bond investors. And this is an interesting analysis from Capital Economics. They say typically policy rate cuts, i.e. central bank interest rate cuts, when that happens, typically it leads to lower interest rates across the yield curve, including the 30-year bonds. That has not been the case this time around. While short-term yields have fallen since policy rates started coming down in the US and in Europe, longer-term yields have not. So that is something to be concerned about. According to MIB, the main cyclical risk is the likelihood that inflation will not follow the bond markets and the central bank's expectations of drifting back to 2% or less. This, plus a historically worrisome trend, I almost forgot the US Federal Reserve interest rate cut. On the 17th of September, the US Fed cut the policy rate, the Fed funds rate, by 25 basis points to a new range of 4 to 4.25%. And the Fed's consensus forecast is for another 50 basis points of rate cuts before the end of the year. One more 25 basis point rate cut in 2026 and one more in 2027. But the scary bit is that these rate cuts occurred despite the Fed forecasting an improvement in GDP growth, higher inflation, and lower unemployment compared to its forecast at the end of June. So it does appear as if there is some impact on Fed independence. So we've got a bit of analysis from MRB on the Fed rate cut. We can only conclude that monetary conditions are still accommodative and becoming even more so on the margin. And there is plentiful liquidity to sustain asset price inflation. Timing the next up leg in yields will be critical for investment returns as we place low odds on a contraction in corporate earnings, triggering corrections in equity and credit markets. Derating pressures from higher bond yields will be the catalyst for trouble down the road. So, let's now move on to the global macro. The global, and this is really what's driving the markets for the moment until we have trouble in the bond markets. So until that happens, we must remain fully invested, and any potential new clients should add funds if they can. The global economic expansion should continue over the next 6 to 12 months, underpinned by healthy household, corporate, and financial sector fundamentals, supportive monetary, and supportive fiscal policy. We have very strong recent GDP growth in the US. In fact, Q2 was 3.8% GDP growth, quarter on quarter annualized. And the third quarter GDP looks set to come in at 3.3% based on the Atlanta Fed's model, which tends to be quite reliable. So we're seeing a pickup in economic activity over the past 2 months. Globally, purchasing managers' indices, which tend to be forward-looking indicators, suggest economic momentum is firming across the globe for both manufacturing and services. Astonishingly, despite the tariff threats, global trade growth is also firming. In spite of all of this, central banks across the G7 economies are in easing mode. with the exception, of course, of Japan. And that is positive for the ongoing economic expansion, positive for corporate profits, and positive for the continuation of the equity bull market. In terms of the earnings outlook, an expected ongoing global expansion implies further upside for global 12-month forward earnings in the year ahead. In the US, consensus earnings forecast is for 13% growth in the year ahead. Global ex-US earnings expected to grow by 10% in the year ahead, with potential upside surprises in Europe and Japan and emerging markets, as global trade growth remains on a solid footing. Astonishingly, US tech sector earnings projected to increase by a massive 20% in the year ahead. And of course, that is keeping the market very firm, but it also means there is a slight risk that lofty expectations are not met. The expectations are less in emerging markets, in Europe, Japan, China, Taiwan, Korea, and possibly coupled with lower valuations in those markets. And Capital Economics and the title of their report that was only sent out a couple of days ago, it's still very, very current, relevant. The title is Why the Bubble in the S&P 500 is Not Ready to Burst. So listen carefully. We wouldn't be surprised if the index ended this year above our current forecast of 6750 and made further gains in 2026 as the hype around AI continues to build. There's in S&P 500 forward 12-month earnings per share is proving to be even more rapid than we had envisaged. The valuation of the index remains below the peak it reached in the dot-com bubble when investors last sought to crystallize the future benefits of a transformative technology. And unlike in the final stages of that bubble, the Fed does not seem set to spoil the party. So despite points in the dot-com era, the forward price earnings multiple of the S&P 500 reached 25. It's currently at just below 23. And this is what's interesting. The forward P ratio of the S&P 500, despite the strong growth in the index this year, the P ratio has barely increased since the start of this year. And in fact, the P ratio of the big tech sectors has actually fallen marginally on net. So in other words, the market movement is being powered by earnings growth, not by multiple expansion. But there's still scope for earnings growth if we were to match that dot-com bubble PE. So based on recent 12-month earnings growth, according to the Capital Economics forecast, so they're expecting $331 in earnings for the S&P 500 at the end of 2026. And if we couple that with a forward P ratio of 25, then the S&P 500 would reach a level of 8275 by the end of next year. Of course, there are lots of ifs and buts, but that's a whole 1,000 points higher than the current end 2026 Capital Economics forecast, and considerably higher than where the market is currently at slightly below 6,700. Umpteen things could conceivably derail the rally in the meantime. They include, for example, faltering demand for AI, a weaker economy, and renewed stress in the bond market, as we've discussed. But an AI boom in the economy is taking hold, and the economy more generally doesn't look as soft as some recent labour market data have suggested. And finally, the bond market would be more likely to come seriously if the Fed tightened policy, as it did in 99, 2000. This time around, the central bank looks set to do the opposite. So until we get a catalyst for the markets to drop, we need to remain positive on the outcome.
Good morning, everyone. I hope the week is going well. Welcome to the monthly market update for the local side. Today, we'll be touching on the following topics: SA macroeconomics, including interest rates, inflation, as well as the latest ABSA PMI statistic, NAMSA new vehicle sales, GDP outlook in SA. Finally, I'll just briefly touch on performance of the JSE over the past month. Inflation. CPI for August came in at 3.3%, a slight drop from the 10-month high of 3.5% seen in July, as well as just below consensus expectations of 3.6%. Main drivers of the stat were food and non-alcoholic beverages, along with housing and utilities. The two constituents that helped ease inflation were food inflation moderating and a steeper drop seen in fuel costs. Looking at a graph of CPI for the year, you'll notice it has been fairly well anchored around the 3% mark, which is the bottom of the 3 to 6% target range. Many would have hoped the lower stat would translate to a higher likelihood of further rate cuts. It could still very well be on the horizon, but we aren't seeing it just yet. If we look at interest rates, late September, the MPC met, and as expected, they decided to hold the rate steady. This comes after 125 basis points have been cut so far in the cycle, which began in September last year. That leaves the repo rate at 7%, and therefore, the prime lending rate remains 10.5%. Prime at 10.5 and inflation at 3.3% is a clear sign that there is plenty of room for additional rate cuts. However, Lesotho Kanyago and the rest of the MPC still sit on the cautious side of the fence. They do not want to risk lowering rates too much too quickly. Lower interest rates take time to influence an economy. The impact doesn't happen immediately. So when it comes to setting rates, the MPC also wants to place significant weight on inflation expectations. In the Q3 Inflation Expectation Survey, the BER, or Bureau of Economic Research, did note that inflation expectations have in fact come down for 2025 and 2026, averaging 3.8% and 4.2% respectively. The Reserve Bank will want to see this come down even further, demonstrating the anchor of 3% before they decide to implement further rate cuts. ABSA PMI. Over the course of the year, any listeners will remember my updates on the ABSA PMI statistic as being, well, quite underwhelming. But not today. Factory activity has decided to leave its snail trail behind, posting the strongest figure since October last year. The September figure of 52.2 was buoyed mostly by local demand, with business activity and new sales orders sub-indices rising strongly. However, SA port issues and global demand remain under pressure. I'm going to take this as a positive. Over the past 3 months, the PMI figure is pointing in the right direction, with 2 of those months above the 50 expansionary point. Let's hope this continues. NAMSA new vehicle sales. September stats have been released by NAMSA, and to say they were impressive is a complete understatement. Sales hit their highest monthly level in a decade as the car market continues its 2025 comeback. On aggregate, new vehicle sales are up 24.3% year on year, bolstered by a surge in new passenger vehicle sales, which increased 28% year on year, reaching its highest level since October 2014. Vehicle exports also surprised on the upside, increasing almost 33% year on year to just under 39,000 units. The lower CPI stat has eased pressure on consumers' pockets. That, together with the rate cutting cycle, has aided in making vehicles more affordable for buyers. It was noted that much of the activity in car sales did in fact take place on the lower end of the price scale. Therefore, further rate cuts would definitely be beneficial for those looking to purchase higher value vehicles. GDP outlook. GDP growth in SA does remain on the weaker side, but there could also be signs of green shoots sprouting up. If you look at a few different economic indicators, you'll see that over the past 6 months or so, our economy hasn't performed too well. Consumer confidence has declined, and the business cycle indicator shows fairly flat economic activity for the same period of time. Looking on the other side of the coin, though, stats like the Energy Availability Factor, or EAF from Eskom, does look pretty strong for this time of year. Another positive is the performance we've seen on the JSE. As many of you may already know, the JSE has hit record highs recently, with the All-Share Index, or ALSI, breaking the 107,000 mark at the end of last week. It has been an extremely strong year for the local market. Q3 saw the ALSI rake in almost 12% in gains, with mining tickers leading the pack. As touched on in our August monthly article, it has been a fairly narrow rally, mostly dominated by resources and telcos, and that still seems to be the case, bar a couple of outperformers. We stand by our strategy of combining offshore ETFs with high conviction plays on local tickers. Should a broader rally take place, our client portfolios are definitely well positioned to benefit from that. Keep your eyes peeled for the last quarter. With structural reform slowly gaining momentum, strong power capacity with less unplanned outages, inflation under control, and a resilient consumer, it's very possible we'll end up seeing some action in the months to come. Thanks, Nick. We'll leave it there for today.